Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi, welcome to the Better System Trader podcast, episode number 3. Today's guest spent 9 years as a professional market researcher for Connors Research and TradingMarkets.com. He's been at the forefront of stock market research, having developed a number of successful trading systems now used by numerous investors and fund managers in the United States and internationally. In our chat, we discussed trading ideas, key concepts and pitfalls of backtesting, the impact of stops on returns, market timing concepts, over-optimization, drawdown, and using multiple strategies in a portfolio. So let's get stuck into it. Don't forget to continue listening after the interview is finished to find out about the session bonus, my top 5 tips from this episode, and a sneak peek at the next one. So let's get to it. The guest for today is Cesar Alvarez. I hope you enjoy it. Thanks a lot for joining us today, Cesar.
Yeah, I'm glad to be here.
Perhaps if you could start by giving us a little bit of the background of how you got into trading and how you got up to where you are today.
Sure. The way I got into trading was back in 1996 is when I first started getting interested in trading. At that time, I just recently left Microsoft. I had a small nest egg to be investing. And I probably followed the traditional approach that most people did. I started off by investing in mutual funds, just trying to understand things, trying to be safe. From mutual funds, probably 97 or so, within a year, I started getting more into stocks, felt I had learned enough about stocks. I started trading stocks at that point. Doing a big, O'Neill was big in that time frame. Of course, I was following O'Neill. Got to enjoy the heady, fun 97, 98, 99 years. I had some amazing years trading stocks there then. And at that time, I confused a bull market with brains. And, even though I had good years, it was just purely because I was in that strong bull market and, got hurt in the 2000, like a lot of people did. Fortunately, not too bad. And around then, I started, I picked up AmiBroker, and that started getting me into my quantified kind of stage, where I started learning about programming, testing ideas. And at that time, I started finding out a lot of ideas out there just did not test out when I tested them. I was really quite surprised. Also around that time, I got to a site called TradingMarkets.com run by Larry Connors. And, he had lots of good strategies there. He quantified his stuff. I would test his ideas. They worked pretty well. And it definitely started getting me more interested in him and his work. In 2004, after 2 years of trying, I finally got my job working for Larry Connors and Connors Research, and really dove head into the whole quantifying all these strategies into mean reversion, seeing what works and doesn't work. I spent 9 years working with Larry, and during that time, I really got my own trading personality down in the sense of being a short-term mean reversion trader. That was all that not all, but that was the majority of our research. And that's where most of the successful strategies that we discovered were. And that's what hit my personality really well. And then in 2013, I left Connors Research to come out on my own. I wanted to do my own blog, start my own trading service. And that's where, in a sense, my whole history is. And now I'm primarily a stock trader, mean reversion. I do both a little bit of rotation, a little bit of monthly holding too. I dabble in options. I think there is great potential opportunities in options. I still haven't found anything that works, unfortunately. Every time I dabble in options, it has a negative impact on my account, as I like to say. But I always do it with small amounts, and I think there's something there eventually I'll find. So there's kind of a quick overview of my trading history and where I am now.
So can you give me a brief overview of your current business?
Sure. Right now, I do several things. I run the quantified research blog, Alvarez Quant Trading. On that site, I like I said, usually publish a couple articles a month on research I've done, mostly on stocks and ETFs. I'm also an Emmy broker consultant where I do testing of trading ideas for others. So I also have an Emmy broker education class, video class that I've got for people to buy. And also got a trading signal service called tranquilitytrading.com, where I currently have an S&P 500 rotation strategy and a leveraged ETF strategy, and looking to add a couple more strategies by the end of the year. So those are my main business that I'm in right now.
Wow, that sounds like you're very busy.
Yes, it does keep me busy, but very enjoyable.
Right, okay, thanks. So your days at Connors Research, you published a lot of different strategies and research. So obviously you tested a lot more than that. Where did you come up with ideas back then?
Back then, while working with Connors Research, I would say 90 plus of the time, Larry Connors would come up with what I'd call the original idea. You plant the seed. And we were, I think, a very good team because he is really, really good with coming up with good ideas. That is something I'll honestly say I'm not great at coming up with brand new, unique ideas. But where my skill really shine is taking a good idea and making it really good. He would come up with ideas and I would improve on them significantly and convert them into something that was worthwhile trading or worthwhile to share to our subscribers or anything like that. So, and nowadays where I get most of my ideas is I do a lot of reading of blog posts. That's where I get my ideas and where I find something and where I want, take things. I'll see an idea and test it out and it look like it has potential and then make it good by adding my own ideas, my own trading style to it.
Right. So you actually you post a lot of research on your blog, and you get a lot of responses with ideas from other people on things to try. How do you keep track of all those ideas?
Like I said, I have to say when people ask me these questions is I have a page that I keep on my computer with trading ideas of things I want to post or eventually research. That page grows at a much faster rate than I can ever tackle it. There's always, if I had to bring that page up, I'd probably say there's probably 100 ideas on there to test. And the next obvious question is, what do I decide to test? It's usually what's something just catches my eye, and I'll decide to test it. Recently, what's caught my eye is dual momentum, a very popular ETF topic on the post or on the internet this year. So I've definitely, as an area I've been doing a lot of research in recently for my own trading. But again, I get it everywhere, and I just have a huge list of stuff that I could stop taking ideas and spend the next several years just whittling down that list. But I'm always chasing the latest, greatest ideas too.
Right. So when you test an idea, you must have some type of expectation on how it's going to work. What do you find after you've tested things?
Yes, you're right. Normally, I have an expectation of whether it's going to work or not. But I had a running joke with Larry Connors. He would ask me, before, he'd send me something to test, and he goes, "Well, do you think it's going to work or not?" And I'd give him my answer. I'd say, "Yeah, I think it's going to work." But then my response back was, "Well, yeah, about half the time I'm right, half the time I'm wrong," and that's why we test. Sometimes things that I think will just fail miserably surprise me and actually, work or work well. And things that I just think that will, this will make money, this will just print money, fail miserably. So even though I may have expectations going in, that is why often on my blog posts, I'll post stuff that doesn't work. People sometimes think that, you just come up with an idea and it works. Or just because I've been doing this for, 10 plus years or whatever, I come up with ideas and every idea I come up with works. It doesn't work that way. And sometimes there is no rhyme or reason of why something works or doesn't work. Of course, if somebody gives me a mean reversion strategy and I can look at the rules, I can tell you pretty quickly, how well it will work or won't work, just because I've done so many mean reversion strategies. But if it's something different, if it's some new twist on something, I sometimes just don't know. And it's really that simple. So I got to test it. And that's why I do the blog. It keeps me testing and sharing with people.
Right, okay. So you have been testing for a lot of years now, so you must have a good understanding of some of the challenges with backtesting. Can you explain a few of those that you've seen in the past?
Yeah, I've got a great post on this called "Backtesting is Hard," and this is one of the things I really enjoy about this line of work is you may think you have found something great, but there's the pitfalls there are just so many potential pitfalls. They fall into just the general category of data. People would be surprised if they knew how dirty their data is. I think people think their data is pristine, if they're getting it off of Yahoo or some other major data provider, that, it's good and it's non-changing and it's fine. There's a lot of problem with the data out there. I've looked at some of the major data providers and I've compared them against each other, and sometimes there's pretty big differences. And you can't really point and say half the time who's wrong and who's right. So data is one of those things I'm always concerned about. That's one major pitfall. Another pitfall that's common for people is just, it's the usual pitfall of data mining. If over-optimizing systems, trying so many different variables or trying so many different permutations, or just, you've done 1,000 permutations, which is not that big of a deal, but then only focusing on the one that did the best and not kind of focusing on maybe the top ones and see how it does in general. That's another general pitfall. And then it's just the basic programming. It's real easy to accidentally look into the future or think you're doing things one way and you're not. I mean, it was recently, was it earlier this year? I think it was. I'd been trading a system for about 3 months or so until I realized that the ranking I was doing was off by a day. So it was not exactly perfect in the way of the code. Lucky for me, it did not have a significant impact on the results, but it was not correct. And things like that. I mean, you may have things that look correct, feel correct, and are just subtly wrong, and the results aren't what you expect. And it can be really bad, especially if you're doing something that's impossible in the sense of you're looking into the future. And then your test results are definitely nowhere near correct. So those tend to be the three major areas that I find can be problematic for most people. And for myself at this point, it's just mostly making coding errors and not catching them. It's always my biggest fear is making a coding error on a blog post, and then I got to retract an entire blog post because I did something insanely stupid. Well, it doesn't have to be stupid. It's just something subtly wrong that it's hard to catch.
Right. So what steps do you personally take to avoid those type of mistakes in the backtesting process?
The steps, unfortunately, I can't do the steps I used to do with Connor's research. So the way we used to do it in Connor's research is, I would, Larry would send me an idea, I would test it, refine it, and I'd finally get something I think, oh, this is a great strategy. We want to trade this, or we want to sell it. What then I would do is I would give the English rules to one of our other researchers, and then they would have to duplicate our results. So they would take, I would tell them, okay, here's the English rules. I wouldn't give them any formulas, and they'd go off and try to duplicate our results. And it seems, that was our best way of verifying that there was no mistakes in our code, in a sense of, granted, it's not perfect, because if you both make the same assumption and it's the wrong assumption, you can get a mistake in there. And it happened once for us. Fortunately, it was a very, very minor mistake, but both I and the other coder made an assumption about something that wasn't a very good assumption, and it was a mistake there. How do I do it now? I just look over trades. You just look over the trades, making sure everything looks right. It's painful. You look at 10, 20 trades and say, okay, does it look right? Fortunately, after doing it for so long, I tend to know where the errors are and where I tend to make the silly mistakes. But that is the biggest fear I always have is, making a mistake, and it's hard as an individual to catch, the subtle mistakes. It's easy to catch, the big mistake of, oops, I'm getting it out at the close when I should be getting it out at the open. Things like that tend to be real easy to catch. Or, oops, my stop's not working, or things like that. Those tend to be the easier ones. The subtle ones are, I'm supposed to be ranking off of today's close, but I'm using yesterday's close. Things like that tend to be really subtle and really hard to catch. Or the really hard things is when you're missing trades that you should be getting, and it's hard to know those kind of things are really hard to find. And it's just, walking through your code and looking at it. And that is why, I have a saying on stuff I see on the internet, or heck, or even my own stuff, is, trust it, but verify it. Nobody out there is publishing stuff that, that is purposely wrong, but, they're human, I'm human, we can all make a mistake. And that's why when you see something out there that looks really good, just don't go trade it. Try to verify the results. It's not that you don't trust them, but they could have made a mistake. Heck, even in my research, if you want to trade off anything I published, make sure you try to verify it for yourself to say, yeah, make sure I didn't make a mistake.
Okay, so one of the challenges of backtesting you mentioned was over-optimization. How do you know that you've over-optimized a strategy?
That's the $1 million question. Or what I like to say, a lot of people try to break up a lot of things within the backtesting into black and white. Of saying, you must do things this way, or, if you do it this way, you've over-optimized. Unfortunately, to me, it's a lot of gray area. And this definitely falls into one of those gray areas of one person's over-optimized strategy is another person's, it looks fine to me, you have not over-optimized it. I remember about a year ago, early on when I started the blog, I got into an offline discussion with a guy who basically thought, the fact that I had 3 different variables means I had already over-optimized it. Which I disagreed with him, but, that is perfectly fine. I told him, look, that's great. If that's what you believe, great. Build your strategies that way. If you take a strategy, make 5 million different combinations of it, you got, 20 different variables. Yeah, most people will agree that you've over-optimized it. But then you have a huge gray area of, okay, you've got maybe 5 variables and maybe you've run 1,000 or a couple thousand variations. Now, well, maybe yes, maybe no. A lot of it, like I said, this is not one of those black and white things where at least from my point of view, where I can say, you know what, if you've got more than 5 variables or if you've done more than 5,000 optimizations, you've over-optimized it. It's not that simple. And for me, at this point, it's mostly feel. I mean, I'll sometimes do 1,000 and feel I'm fine. Sometimes I'll do 1,000 and feel like, you know what, I've over-optimized it. And I go to the other extreme. I'll do an optimization run with 20,000 and feel like, you know what, I haven't over-optimized it yet. And a lot of it is feel. A lot of it also is, the way I like to look at it is, at the end of the day, let's say you've done 20,000 runs. But at the end of the day, you're looking for one of these runs to trade. Well, okay, you pick some run that you want to trade. Well, what do the runs around it look like? That to me is more the important part. Is okay, so you've got when you tweak the parameters slightly from the one you picked, do you still get similar results, or do your results suddenly fall off a cliff? And that's even more important in my book than over-optimizing, is not picking a result that when you slightly tweak your parameters, you go from a great system to a system you would not trade. And that's in a sense where I kind of maybe get around the whole question of, did I over-optimize? Is, did I pick a strategy that is not sitting on a cliff, or also not necessarily sitting on the peak, but maybe near the peak, but not necessarily on the peak? Does that make sense?
Yeah, sure, that does. So it's a consistency of the results based on the variables around it.
Yes.
Yeah. Okay, so that's interesting. I guess that's going more towards the art of backtesting, which is difficult to quantify, and it's not just the science of it. So.
Yes, it is definitely. I think that part is more of an art. Some people will think, like you said, it's got very different, you've got more than 3 variables, you've over-optimized, like I said. But at the end of the day, you trade your own strategy, so you've got to be comfortable with what you've done. In a sense, you got to live with what you did, and you're going to go try to make money off of that. So, if you think you've over-optimized, well, you're going to be uncomfortable trading it. So you probably have. If you think you haven't, then, good. That's good too, because then you'll have confidence in trading it.
Right. So you also mentioned one of the challenges with backtesting is data.
Yes.
How do you split your data when you're testing? Do you use in-sample and out-of-sample data for that?
No, I do not. This is, again, I know certain people who I've probably now they're standing up screaming at me for saying this. I do not believe in using in-sample and out-of-sample. Again, this is back to our black and white and gray thing. Some people think this is black and white. Um, I think, it depends on the person. Here's why I do not use in-sample and out-of-sample data. And like I said, this is just my opinion, and this is how I develop my strategies, and this is why I trade my strategies. I'm comfortable this way. Let's say you have 10 years of data, and then you want to use the first 5 years as your in-sample and your last 5 years as your out-of-sample. The problem I have with doing something like this is, here's how most people will do it. They'll take those 5 years, develop their strategy, then run it on the out-of-sample data and say, that doesn't look very good. Let me try again. You know what? You already took your one bite of the apple. And if you're going to be really true to in-sample, out-of-sample, you should just stop right there and just throw away your idea. The problem is 90% of the people don't do that. They say, well, that wasn't quite right. Let me try again. And you know what? At that point, you've just blown the whole in-sample, out-of-sample problem. So that's one reason I don't use in-sample, out-of-sample. And the other reason is it's back to data. When I test, I like to test on probably on an 8 to 10 year look back. And the reason it's kind of around that time frame is I want to go through one bear market, one bull market, one high volatility time frame, and one low volatility time frame. And that usually coincides to a bear market and a bull market. And I don't like going farther back. And you can say, so my typical test right now starting 2005, which gives me 10 years of data, a little bit of a bull, followed by a bear, followed by another bull, both low and high volatility timeframes. And you may say, well, why don't you go back to 2001? The reason is the farther you go back, the less and less I trust the data. And markets just change. That market of 2001 is very different, and I don't think it's going to happen again. Structural changes have happened also, happened to the markets throughout the years. In 2001, we had penny pricing show up. So I believe that structurally changed the markets. In the mid-2000s, we had high frequency trading show up, and we had, the access to data and easy to backtesting show up, and also changed the markets. So that also causes a problem for doing the in-sample, out-of-sample. Well, if I go back 10 years, I do the first 5 years of my test is in-sample, well, I'm going to go through a major bear market of 2008. And then the last 5 years are a major bull market. So that's kind of weird that you've got an in-sample that's covered a major a major bear, and your out-of-sample covers a major bull only. And then people say, well, go back farther. And then, that gets into my problem of, I trust the data less the farther you go back, and then markets are just very different and not likely to repeat back from back then. So that's my long way of saying why I don't do in-sample, out-of-sample. Some people are religious on that. To me, that's my reasoning for not doing it.
Right. So if you've backtested, say, the last 8 or 10 years up until today, and you have a strategy that you'd like to start trading, do you start trading that immediately?
I'll usually start trading it within a month, because what I'll usually do, so I'll get the strategy, I will, figure out which one I like. I'll develop then the code that generates the signals, and then I'll just generate those signals for a month, mostly for a sanity check to make sure I haven't done anything silly, and make sure the signals are being generated correctly. And then I'll start trading it. At the end of the day, what really counts is, does your strategy make money? It's not how to do it in the back testing, but how's it going forward? And the only way to do that is to trade it live. Usually I trade it when I start a new strategy. I trade it at full size. Whatever size I was planning on trading it, I start trading it at full size. And then I just keep an eye on it. Especially the first 3 to 6 months. I make sure, is it behaving the way I expect it to in the current market environment? Just making sure, is it meeting my expectations in both volatility? Maybe there's some looking for, this is usually where I potentially find any programming errors that I might have done when I originally wrote the strategy. There's nothing like putting real money on the line to really make you look hard for your bugs in your code.
That's right. Yep. So you mentioned the changing markets over the last 8 or 10 years. early 2000 mean reversion strategies did pretty well, but it seems that the last couple of years returns have been dwindling. Why do you think that is? Is mean reversion as a strategy dying?
Um, I think that it's a couple of factors have come into play here. First, mean reversion is not dead in my opinion. Last year, my mean reversion strategies did pretty well. My overall account did not do as well as I like, but my mean reversions more than held up their weight. Now, are they doing as well as they did in the early 2000s? No. I attributed this to two reasons, and it's back to what I already mentioned. One is I think high frequency trading has really what I call softened the sell-offs and then the subsequent recoveries of stocks on the short term. So I think some of the returns have been eaten away there, and also there's a lot more people in the early 2000s. 2003, 2004, 2005 when I first got into this. People really didn't talk about the two-period RSI or mean reversion. It was not a big topic. The internet was not as big as it is now. Now, everybody knows about it. Everybody trades it, and therefore, it's you just got a lot more people trading it, and the edges have just gotten a lot smaller. Do I believe they're gone? No, not my testing and my own account say, this still exists. Do I believe it's gotten? Are they as profitable? Unfortunately, no. They're definitely a lot less profitable, but they're still profitable enough for me to trade.
Thank you. A lot of the books, the Connors books that you're involved in publishing, seem to prefer exits based on technical indicators or price behavior rather than using fixed stops. Why is that?
Because they don't work 90% of the time for mean reversion. It's as simple as that. I remember one of my, probably in 2005, when I first started working for Larry Connors, we were doing some strategy, and of course, at that time it was, you've got to have stops, you've got to have stops, you've got to have stops. And Larry sent me some research saying, okay, whatever it is, two-period RSI is less than 10, and you get in, and then you've got, whatever, your 5% max loss stop and a 10% profit. I'm just making this off the top of my head. And, I ran these numbers, and it all looked great and everything. And, and then it was like, what happens if I make the stops bigger? And I slowly made the stops bigger and bigger and bigger. And it finally got to the point where it's like, what happens if I just get rid of the stops? And it just, every time I made the stops bigger, the results got better. And when I got rid of the stops, the results got even better. At the end of the day, the stops are a psychological insurance. If the stops help you trade and stick with the system, great, use them. But it is insurance, and insurance costs you returns. So 90% of 90% of the mean reversion strategies that I've traded in the last 10 years do not use stops. Mostly just because it does not work, or I shouldn't say it does not work, greatly reduces returns. And then usually the follow-up question is, well, what do you do? I handle it by position sizing. I position size such that if for some reason the stock were to slowly dribble down and lose 25, 50%, it would not kill my account. Now, psychologically, it may be a little bit painful, but it will not kill my account. And in reality is most stocks don't slowly dribble down 50%. They open down 40%. And the stop would have been not done you any good. So that is why I don't use stops most of the time. The funny part is on that whole equation, the leverage ETF strategy that I have a service for and trading does use stops. And I think why it works here is because these are on an index and these are leverage ETFs. And I'm trying to basically catch the bottoms of these bounces. And if I don't, I get out. So, that is one of those rarities where, it's the first time in a long time that I'm using stops in my own personal accounts. It drives me nuts, though, on watching, getting stopped out. But, that's the way the strategy works best with. And it's one of those rare ones where even a mean reversion strategy was working good with stops.
So that's a very interesting perception, because I guess when we all start trading, it's drilled into us that you always need to use stops. But I guess that goes back to your one of your initial comments that you need to trust it but verify it.
Right.
I guess you could say your stop is sitting at 0, right?
Yeah, you can say my stop sitting at 0. I mean, I'd have to say, without off the top of my head, the worst loss I've probably had that was not because of a large gap, but a stock just, going persistently down, was probably in the order of 30 to 40%. And, I know you're probably cringing at that number, but that, it is not like it happens every month. It might happen once a year, once every other year. Now, granted, I've had larger losses because of, a stock opening down 50%. I've had that happen. Heck, I think my worst last year, I had a stock open down like 70%.
Ouch.
And at that point, a stop would have done you absolutely no good. And actually, in that particular case, it would have hurt you because it opened down. Because I remember it bounced huge too. So it ended up being maybe only a 50% loss. But so yeah, I mean, most of the times, these huge losses that people are trying to avoid, you can't, because they're overnight gaps. And there's just nothing you can do about those.
So if a stock does gap down 50% or a percentage that's outside of its normal behavior, do you continue holding it until you get a proper exit?
Yes. The reason I pause is it is psychologically insanely hard to hold those, but in my testing, it usually pays to hold. To hold those, they will usually bounce. I mean, you got to remember, let's do this thought experiment in a sense of, let's pretend the stock dropped, you got $10,000 worth of stock, and it opens down 50%. Now it's at $5,000. The major damage has been done already. At this point, the stock's down 50%, major damage has been done. So I'm right now looking at, let's just wait for that bounce. In my testing, that bounce always seems to be better to wait for the bounce. Now, does that say the bounce will always happen? No. Sometimes, it would have been better just to get out that day. But you play the odds. That's why we do quantified trading. Quantified trading is not about it being, knowing for sure. It's knowing, well, if I do this enough times, my edge will show up. And I know, well, if I get enough 50% losers, which thankfully I don't, but on average, it pays to hold them. We'll hold for that bounce. Now, the key point of all of this, there's 2 key points in all of this, though. One is you need to have a plan going in before this happens. Meaning, you know what? If psychologically you can't handle it, maybe your rule should be, if a stock opens down 50%, I just get out. There's nothing wrong with that, as long as that's your plan ahead of time. Making your plans during while something is happening is the absolute worst time to be doing it. And the other, this is something I've mentioned before, and I probably should really do a blog post on this, is trading can be a really solitary endeavor. And it's really good at times, especially when your strategies are going poorly, or one individual stock trade is doing poorly, to talk to somebody. And I always say it's really good to have a trading buddy. I've got a good friend of mine. I've known him about 11 years now. He's my trading buddy. You know what? Well, if I have a stock that opens it down 50%, I've got an email or text to him going right away saying, I just lost 50% on a stock. And we'll likely talk that day. And he will make sure, my emotions don't suddenly take over and I decide to get out emotionally. He'll remind me, what's your plan? And it's like, well, my plan is to wait for it to bounce. It's like, good, don't get out of it. So that helps me follow the plan. You can have a plan, but it's hard to stick to it. And having somebody else to talk to and hold you accountable to that plan really, really helps. Having a trading buddy really helps you through either hard times in an individual stock or even hard times when your portfolio is just getting crushed or the market's getting crushed, to making sure you stay to your plan.
That's a great tip, actually, having a trading buddy to keep you in check. So thanks for sharing that one. It's a great idea. You've mentioned a couple of challenges psychologically with trading mean reversion strategies. Perhaps that type of trading isn't for particular people. How do you find a strategy or a system that fits your personality?
Unfortunately, this falls into the really tough, at least for myself, and I think for a lot of people, is you don't know until you trade it. I mean, a lot of things, a lot of numbers look great on paper. It's like, oh yeah, I can handle a 20%. I remember very often when I was working with Larry, we'd put out strategies or different variations of a strategy, and people always, would kind of go to the strategy that the highest return. But the highest return tend to also have very high drawdowns of 20, 30, 40%. And something I quickly realized, even though people claim they can handle high drawdowns of 20, 30, 40%, and actually 20% is not that high in my book, most people start to freak out at a 10% drawdown. I know of only 2 traders that I've met and have confidence in what they've told me who can handle drawdowns of over 40%. And they regularly have drawdowns of over 40%, just because they're very aggressive, but they can handle it. Most people can't. And the problem is when you look at something on paper and say, oh yeah, I had a 40% drawdown, but the next year it was up 100% or whatever. People say, oh yeah, I can handle it. You don't know that until you trade it. It took me a long time to find what I like. I probably a lot of people. I tried day trading, and you know what? After a couple months of it, I realized, it's just not my cup of tea. So a lot of it is, one thing I advise is don't paper trade. I think paper trade just does not show you your emotions. Nothing will dig at you like real trading where real money is on the line. Yeah, you don't need to do a full size. But do real money with maybe a third of the size or the quarter of the size or even a tenth of the size, enough such that, losing the money makes you kind of annoyed. And that's when you find out whether, how much of a drawdown you can handle, whether a particular strategy meets your personality. Some things are easy in the sense of, okay, I've got a job, so therefore I can't be watching the day, during the markets during the day. So, that obviously makes it really easy to say, certain type of strategies that you have to be watching the market during the day may not happen or work for you. But, maybe you can't handle buying, pullbacks, and you want to be more of a breakout trader because that psychologically makes it easier for you to buy, which is fine. I mean, but again, a lot of it I've discovered is unfortunately pure trial and error. You got to try it and say, discover, can I stick to it? It's easy to stick with a strategy when it's making money. It's when it starts to lose money that's when you find out, is the strategy something really that you can trade?
Right, that's some great tips there. Thanks again. I'd just like to move on to your website, tranquilitytrading.com. You offer a couple of trading strategies there called Weekend Stock Trader and Leveraged ETF Trader. Can you explain a little bit more about the style of these strategies?
Sure. So the Weekend Stock Trader is an S&P 500 rotation strategy. On a high level, it is basically looking for a recent sell-off and then a bounce, and the bounce hasn't, been excessive. It's just that strategy I trade. Both those strategies, I trade variations of them, not necessarily the ones that are up there because, not because I don't believe in those, but because I'm able to tailor any strategy to meet my risk profile exactly to what I want. And what I like about that strategy is it doesn't take a lot of time. It takes 5 minutes on the weekend for me to do. It gets me exposed to the S&P 500. Most of my typical mean reversion strategies tend to have, the smaller cap stocks in it. I'm always looking for something with exposure to the bigger cap stocks, and that gets me that exposure. And it tends to be also, in the market much more often. It's meant to be in the market more often, and that catches it. But also, it's got a all my strategies, try to limit all the strategies I personally trade, and these also try to limit the downside risk. And I try to stay away. I've got a market timing indicator in there that gets me completely out of the market, and I've also got filters for the individual stocks. If the individual stocks start showing too much downside volatility, I just throw it out from consideration from trading, because again, I'm trying to avoid the downside volatility. Is it going to be perfect? Of course not. And this actually gets me to, I'm going to go a little off topic here, both on these strategies themselves that I have on Tranquility Trading and just on people's own strategies. people seem to think that strategies should make money every month or should beat the market every year. You know what? I think that's a noble goal, but unrealistic goal. If you're beating the market every year handily, you should be managing a lot of money, kind of thing. Sometimes your strategies get out of sync, and I think that's something people need to realize. I know this is a little bit off topic there, but just that came up. Now onto leverage ETF trader.
Sure.
I've always been looking for trying to find something on the ETF side. I was working with a fellow researcher, David Wallmunster, and this is a strategy he originally came up with the original idea, and then I tweaked the idea to, really, I think, take it to the next level. And, this is mostly a mean reversion strategy, but on, the leverage ETFs, index leverage ETFs. And this is just looking for taking advantage of more of the index. The index can sell off sometimes, but you're just not getting a lot of triggers on a typical stock mean reversion strategy. And this strategy takes advantage of those times. And also, typically you need to use the leverage when you're trading ETFs if you want to get decent returns. And that's what's the good part about this is, we can use both the leverage ETFs, both long leverage ETFs and the inverse leverage ETFs to get some good returns. But because of that, we're also use some stops to make sure, because we're using these leverage ETFs that, the losses don't get too big on us. That's, like I said, that strategy is just a recent addition, and I've been just started trading it, and it's been very interesting trading it and seeing how it's going. We'll see, we'll see how it goes for the rest of the year.
You just mentioned market timing when you were talking about the weekend stock trader. Can you explain a little bit more about that? Sure.
In the simplest sense, and it's not what I mean by market timing is, some sort of filter or some sort of rule that I apply to the S&P 500 index to say whether I want to even be considered trading the strategy. And this is not what's being used in the weekend stock trader. But, the very simple one, the one I often write about on my blog, is using the 200-day moving average. And just saying, I'm not taking trades at all in this strategy when the S&P 500 is below its 200-day moving average. Things like that, they keep you out of the market when things get really tough. Now, often though, those are times where the strategies can also do very well, but at a cost of much greater volatility to your portfolio. So that is something, that needs to be taken into consideration. Is like if you're trying to have higher annual returns, sometimes ignoring the market timing works to your advantage, or just changing it slightly. But like I said, I tend to focus on minimizing drawdowns, and doing that in the easiest way is just some sort of market timing indicator that just says, market's just not a good time. It's not a good advantageous time to be trading the market on the long side during these time frames.
Right, and I guess as well that the weekly time frame may be a little bit foreign to people. When we start trading, there's an assumption perhaps that to make big money, we need to go into the smaller time frames and like day trading and do lots of trades. How did you come about looking at the weekly time frame?
Yeah, I mean, it kind of is. I guess I have to agree with that in a sense of as you compress your time frame, the higher your possibility of annual returns. But like I said, on this particular weekend stock trader, I was not saying, "Oh, I've got to make these huge returns." And, I knew by going to the weekly time frame, my returns would be less. But what I was giving up for that was just my time commitment to the strategy. It's one of those I knew ahead of time. Okay, because I'm trading weekly, my returns will be less. But because my returns are less, I'm willing. I better get less of a drawdown. But it's going to fill a whole bunch of different things. Less return, that's okay, but it gives me exposure to the large cap S&P 500 stocks, which my other strategies did not. And by being forced to be in a weekly time frame, and also by taking a trade and holding it for 5 days, you give it a little bit more extra time for its potential bounce. And sometimes instead of getting out a little bit, now I wouldn't say early, but it's the typical mean reversion, you may hold on to it a couple of extra days and get a little bit extra return out of it. So again, it was just trying to mix things up for the strategies that I was doing.
So why do you like to mix things up and try different strategies?
I all strategies aren't working all the time. You know, strategies go in and out and sync out of the market, and that's why I'm currently trading 4 different strategies, and I don't expect them all to be making money all at the same time, and actually hope they aren't that way. I want them to be when one's strong, maybe one's doing a little bit weaker, and that's why I try just to mix up my strategies, even though most of my strategies tend to be mean reversion like. I still try to make them different enough that they're not all, in the same stocks or the exact same, sectors or things like that. Just make them different, so they're not all chasing the same general thing. And it's, I definitely discovered that last year. My mean reversion stuff worked pretty well last year. My rotation strategy worked less well last year. I'm not sure how they're doing this year. I haven't looked at this year to see. I usually don't look, I look in 3-month chunks. So I guess we're almost into the 3rd month. I'll have to take a look and see how my strategies are so far doing this year.
Right. Okay. Thanks for that. So I might just wrap up now with some general trading questions.
Sure.
What's the biggest lesson you've learned through trading?
The biggest lesson I've learned is what to do with trading mistakes and have a plan and how to deal with them. And what I mean by that is you accidentally type in the wrong symbol and then, you enter the wrong symbol. What are you going to do? Or, you need to have a plan ahead of time. I've seen so many traders really screw that up. And heck, I've screwed it up myself. Know what your plan is when you make a trading mistake.
So this probably links to the previous question. What is the best trading advice you've ever received?
Yeah, it is. It's cliche, but have a plan. Know ahead of time. It's not the wrong time to be making your plan is right in the middle of your trade.
Can you share one of your personal habits that you strongly believe contributes to your success?
I'm constantly doing research and I'm sharing that research, trying to get feedback back. That definitely is, that's definitely what's helped me a lot.
Okay, thanks. And what about a favorite website or online resource that you'd like to mention?
I'd mention 2. If you're an AmiBroker user, the Yahoo AmiBroker boards are great. Great way to learn more, not to learn any trading ideas, but more tricks and tips on how to use AmiBroker, which I think is an amazing tool. And for trading ideas, thewholestreet.com. Oh man, I just love their aggregation of things. I get so many of my ideas from them now.
Yeah, that's a great website, that one. Favorite trading books?
Of course, not counting my own books. It's actually a non-trading book. It's any book by Dan Ariely. He did Predictably Irrational. The reason I like his books for trading is it really shows you how irrational we can be with money. And to me, I think a lot of even quantified trading, still there's a lot of emotional part behind it. And just understanding that and understand what yourself and all the stupid mistakes that you can do. I think those books really help my trading.
Great. And finally, what's the best way for listeners to get in touch with you?
Yeah, they can if they go to my Alvarez Quant Trading blog. There they can read up a whole bunch of my strategies, things like that. And you get a contact form there that if they want to contact me, if they have any questions about anything or discuss an interview, they can do that there. And also, to any of your listeners, if you go to my blog now, you'll see that my AmiBroker 101 course is currently closed. But if you mention that you heard this on this interview here, I will open it up just for you. I don't know when I'm going to plan to reopen up that AmiBroker course. It's currently closed, mostly because I have other projects that are keeping me really busy. But if any of your listeners are interested in taking that, I will open it up just for them.
Oh, thanks a lot for that offer. That's very generous, Cesar. So thanks so much for sharing your knowledge and experience with us today. Is there anything else you'd like to mention before we wrap up?
No, Andrew, just want to say thank you very much for taking time to talk to me. It's always love talking about this stuff. And if you got any other future questions, just definitely shoot me an email.
Oh, fantastic. Thanks a lot. So I highly recommend everyone head over to the website alvarezquanttrading.com. It's got so much great information there. You can check out more of Cesar's work. Thanks for your time today.
Thank you.
So what did you think of that? Loads of great info from Cesar today. Here are my top 5 tips or insights from the episode. Starting with a quote. Sometimes there is no rhyme or reason why something works or doesn't. We heard how some ideas that we think won't actually work do. So I guess you can never really know until you try it. So even if you think they won't work, test it anyway. You may be pleasantly surprised. There was a great tip in there on identifying over-optimization. That was, if a strategy works well with one set of values but falls off a cliff if the values are changed, then the system may not be robust. You may have over-optimized those values. Third point, the in-sample and out-of-sample debate was interesting. Splitting data into in-sample and out-of-sample portions can make it difficult to test strategies over various market conditions. However, if you test with data from the past 10 years, you will experience bull and bear markets along with high and low volatility environments. So something to keep in mind whether you do in-sample, out-of-sample testing or not. Market timing. So some strategies work better if you exclude them from certain market conditions. So if you can identify that and include a simple filter to switch a strategy on and off when conditions are or aren't ideal, you'll get some better results. And I also found it interesting the impact of stops on returns. The quote was, stops are insurance and insurance costs money. So mean reversion strategies can produce higher returns without stops, but there's obviously some drawbacks from doing that as well. So some good ideas for testing mean reversion strategies there. So for those interested in hearing more of Cesar's work, he'll be presenting at the ATAA conference in May. Every year, the Australian Technical Analyst Association hosts a national conference for all budding and practicing technical analysts, traders and investors. This year, the conference will be held on the sunny Gold Coast in Australia in mid-May and will feature 10 overseas and local speakers in 14 formal sessions, one of which is Cesar. So this is in addition to lots of networking opportunities, including the conference huddle sessions. It's a great opportunity to meet with like-minded traders and investors over a focused 3-day period away from the normal pressures of everyday life. I went along last year and it was a great experience, so I highly recommend it if you can make it. For more details, visit the ATAA website, which is ataa.com.au. I'll also add a link to the show notes as well, so you can find it easily in there. Speaking of show notes, don't forget to check them out for this episode too. We have more details from the interview, including web links, books, quotes, transcripts, and bonus content. The show notes can be accessed directly by typing bettersystemtrader.com/ and then the episode number. So for this episode, which is episode number 3, just type bettersystemtrader.com/3 into your browser and you'll jump straight into it. Oh, and one other comment before I tell you about the next episode. Cesar kindly offered to open his Amy Broker coding and backtesting course again just for Better System Trader listeners. So if you are interested, head over to his alvarezquanttrading.com website and click on the course link, or you can find the link in the show notes for this episode as well. I'll add one in there. The course offer expires on the 20th of May 2015 and class numbers are limited, so if you're interested, you should get in quickly. So in the next episode, we have a guest who is a professional trader, analyst, educator, and author. He's been trading since 1985, and he was a floor trader at the Sydney Futures Exchange. He's also worked for international banks in London, Singapore, and Sydney. He is an expert in trading system design and technical analysis. In our chat, we discuss system design, the best types of systems to trade, how observations can lead to better strategies, the best way to handle a bear market, measuring system performance, survivorship bias, and the difference between successful traders and everyone else. It's a fantastic interview, so you don't want to miss out on that one. Anyway, that's it for this session. I hope you enjoyed it. Thanks for listening to the Better System Trader podcast, and please share with your friends. Catch you next time. Ciao.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.